Okay, so moving on to part three. This is where I'm going to give my macro outlook of where I see things at the moment. It's important to remember this is all just purely my take and what I see going on in the markets. So, mixed data. It's really sort of keeping investors split on the next FOMC rate decision that's coming up early in May. It's sort of bouncing around between unchanged and a 25 basis point hike. At the moment, I'm going to have to say that I have to go for the latter. I do believe that pretty much the majority of central banks and the US included in that are very, very close to their peak. And then, it's not as they're going to sort of drop them back down or do anything. For me, it's just a wait and see. As I keep saying week after week, they're going to want to have proof that they have sort of winning the battle against inflation. And at the moment, they may be, but at a very slow rate. Now, the US approved LNG exports from Alaska, which could help keep a lid on prices. And then on top of that, I mean, because of the mild winter in Europe, storage is at record levels. And of course, they're going to top them up before we get into next winter. Uh, Interestingly, the IMF is at odds with the US and UK over their economic outlook for those countries. Uh, when it comes to the US, I mean, the dollar remains under pressure still. I suppose, it must be providing some sort of relief to the emerging markets. It does push up prices of commodities a bit though. And surely lower inflation and an end to rate increases is a positive. Unfortunately, the US still's not sort of resolved their debt ceiling issues yet. That horse trading is still going on, but come the summer, that could be a problem if it's not resolved. And of course, the rate increases that have taken place, all these aggressive rate increases, they haven't really filtered into the economy yet. And so those expectations of a recession continue to grow. Now, central banks for me were a little bit too slow on inflation, reacting to it and trying to control it. And since then, they've panicked. I still believe that rates possibly could go just a little bit higher. But as I keep saying, they're going to stay higher for longer. And even if there's a full-blown recession, uh, possibly it's going to depend on the depth of it. But I'm still not sure that rates are still going to come back down to this 0 or 1%. I think that the central banks are going to be more cautious in future about making those rate cuts. Now, in the US, once the debt ceiling is finally raised, that's going to be interesting because, the Treasury may have to issue a huge amount of treasuries to actually get that funding back on track. Yellen's been sort of taking it from different areas of within the government departments where she could, but that's not going to last forever. And it's possible that it could be around, I don't know, 700-800 billion that they're going to have to raise by the end of the year. Now, of course, if they do that too fast, then they could cause some issues in the money markets. And that's because the banks need to keep their cash levels up to within certain regulatory requirements. And of course, if they're having to buy all these treasuries, that may drop them down below those. So that can have a little bump in sort of like overnight money rates. And it happened sort of a year or two ago when the Fed was sorry, not the Fed, the Treasury was issuing a serious amount of treasuries, and the overnight rates popped, and then it took the Fed to come in and sort of add the liquidity to stop it from getting any worse. Now, the US jobs data, as I mentioned, continues to soften. As I've been saying for a while, I just don't believe all these job offers are just going to stay there. I think that the job offers are going to sort of slowly but surely evaporate. And I also expect the unemployment numbers to grow. Just when you look at the economy and consumers, and although the rate hikes have made borrowing more expensive, for me, it's actually the prices themselves that's reducing demand. We all notice it in the shops. And if you're on sort of low or middle income, then that's probably having a massive impact, and you're having to make some serious decisions on where you actually spend your money at the moment. And also, if you compare prices from 2021 to now, I would say there's been some huge increases in things. Okay, I just want to talk about the sort of geopolitical situations at the moment. I mean, obviously we've still got Russia, Ukraine ongoing, and this could get a little bit more complicated. Obviously there was some secrets released about sort of strategy there, but if we're talking more about sort of the markets, then I'd keep an eye on grain prices, for example, because Russia's refused to extend the sort of the Black Sea agreement that they had in place past the 18th of May. And so I think that you could see grains and fertilizer prices increase because that corridor may close. Further supply issues, I think sort of since COVID have really convinced governments that they need to produce more domestically rather than rely on other nations. And those supply chain issues that we've been so dominant, and also another cause of inflation, sort of really highlight that. Now, there remains considerable tension between the US and China. However, that saying, I mean, their trade levels remain high. But China is looking to cut its dependence on soya meal for animal feed, which again could, sort of change the demand for soybeans going forward. Now, energy has sort of become almost a political minefield at the moment, and it seems to be growing, especially now the Saudis seem to be moving more away from the influence of the US and getting closer to Russia. Hence why we saw that sort of over 1 million barrels a day cut in supply of oil. But to be honest, I think world trade is changing. Look at it with the UK. We've joined new partnerships, and we're looking to do more. China's looking to do the same. And then you've got Russia that's creating new trade routes to replace European sales of such products as gas and gasoline, so energy-based ones. They're now exporting to Africa, Nigeria, Tunisia, Libya. And of course, if we sort of go back to grains, as I mentioned earlier, then Egypt's having domestic problems because of such high commodity prices. They're the biggest importer of wheat in the world. And that's just stretching supplies in the country. And of course, just to finish off on this part, is that Macron did sign his pension changes into law, changing the ages, etc. And we could see more aggressive demonstrations coming out from France because of that. Okay, so let's go back to the data. I mentioned this earlier, but I'm going to mention it again, is about the bond market sort of indicating a recession's on the way. That said, for me, it seems like before we get to that point, stagflation is going to be the order of the day. And to be honest, I think it's all, to a degree, it's already with us. That data just seems to send such mixed signals. Inflation certainly has not been beaten yet. And I still see little improvement this year, to be honest with you. What you've got to remember here, it's going to take months and months of inflation at 0.17% or less to achieve 2% inflation rates. Okay, so firms are going to be reporting their Q1, and that's going to sort of really pick up the pace this week. And you're going to continue to see this high volatility in stocks. I mean, they was incredible last week. It was crazy, sort of, the levels you could sell at and the levels you could buy at. I mean, it was amazing. I really enjoyed it. I don't trade Nasdaq that often. I have to have some really strong convictions on it. But yeah, last week was a good week. In the US, headline CPI dropped below core CPI, which is interesting. The core's at 5% versus, headlines at 5% versus 5.6% year on year for the core. Now remember, the core excludes food and energy. So, that is a little bit strange, but of course, gasoline prices are remaining lower. They're down 4.6%, but food's not been so lucky. Something that's adding to inflation there, airfares still. They increased 4%. Fortunately, rents are beginning to stabilise now. Retail sales slowing as you would be sort of expecting them to happen with consumers cutting back. So that was the USA. In the UK, we've got a mixed economy. I'm in the UK, so obviously. So GDP was flat. Again, the economy is being impacted by the odd strike still going on. And of course, consumers cutting back as well. Now, mortgages continue to be expensive. So, again, that's putting more pressure on the rents, where people, some people that are already in that sort of area of buying their own homes or looking to buy their own home have had to decide to rent instead. And, which is great for the landlords because they're getting a choice of probably anywhere between 5 and 10 candidates for a property. So they can be very selective on, who they decide. And for me, that sort of leads on to why governments just don't build new towns and cities. In the UK especially, it's sort of baffling when there's only 7% of the country that is actually residential. Now, that's land mass, by the way. Gilts saw their strongest demand in 2 years. And, to me, that makes sense. Investors should be keen if interest rates are getting very close to the peak. That, if you've got that spare cash and you don't want to put it into the riskier assets, stocks, commodities, etc., then probably, if you don't need that cash for 5 years or more, then it's probably a good place to park it at the moment because at least you're getting that guaranteed return. For the Eurozone, I think that, they're performing a little better. Production increasing, mainly driven by Germany, though. They was up 2.1%, and I would say that's probably just because of China reopening and demand growing from there. So we're in for another interesting week. To be honest, I think it's going to be an interesting year. It's just going to be stop and start all year as we try and second guess what central banks are going to do and what the economy is going to do, and certainly inflation. So I look forward to catching up with you again next week for the fundamental elements. I'm now going to go to part 4 where I'm going to move on to the technical analysis part. Again, before I do that, just a reminder of our services there. And also another reminder that this week I'm doing a series of workshops, and Monday afternoon from noon there's a free 2-hour introduction to trading if you need it.